I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. At Montgomery, we focus heavily on a company's prospects. This refers to the outlook for the company's earnings growth. While a growing earnings stream is valuable, not all growth is equal. The value of growth is determined by the amount of capital the company needs to invest to fuel that growth. The lower the amount of capital a company needs to reinvest to generate the growth, the more valuable the growth is to shareholders. Or in other words, the higher the marginal rate of return a company can generate on reinvested capital, the more valuable the resulting earnings growth will be. A lower amount of capital that needs to be reinvested to generate a given rate of future earnings growth leaves more capital to be returned to shareholders in the form of dividends. Alternatively, it provides additional capital for reinvestment into other growth options. In this video, I will briefly discuss two types of growth: organic and acquisition. Organic growth refers to reinvestment in a company's existing operations. For example, increasing production capacity or investing in internal development of new products. Reinvestment can also be undertaken through operating expenses, reducing earnings growth in the short term to generate a longer term benefit. An example of this would be a company increasing the size of its sales team or employing people with new or enhanced skills. Acquisition-based growth tends to be more lumpy and larger scale, although it can also be represented by smaller scale acquisitions in what is known as a bolt-on acquisition strategy. Acquisition growth tends to be lower return than organic growth. This is because the acquirer generally needs to pay the seller of the business a price that shares the longer term benefits of combining with their existing business. If one company is generating growth by investing in its own assets, it is likely to have a marginal return on capital that is greater than the company that is acquiring its growth by buying other businesses. As acquisitions not only pay for the investment in hard assets like property, production plants, and working capital, but also include a premium in the form of intangible asset value. To offset the higher investment per dollar of acquired earnings, companies will generally rely on synergies between its existing and the acquired business to boost net return generated. Not only does acquisition growth tend to be lower return, but it also comes with added risks. Two such risks are cultural and disclosure based. While the synergy opportunities might appear logical on an investment banking whiteboard, the respective cultures of the two companies that are merging are a critical factor in determining whether these benefits will be realised. Customer response to the merger is also important. From a disclosure perspective, it is difficult for an acquirer to gain a complete understanding of the assets and issues associated with the business they are purchasing. For the equity market investor, acquisition accounting allows the acquirer to change the book values of the acquisition's assets and liabilities through a fair value adjustment. These adjustments are not disclosed to the market and can distort the earnings of the acquired business. This is a particularly big red flag for companies acquiring businesses with longer dated working capital requirements or large investments in fixed assets. So in valuing the prospects of a company, it is not only important to assess the size of the earnings growth opportunity, but it is equally important to assess the quality of its growth. A good place to start is in differentiating between the value of organic versus acquisition-driven earnings growth strategies. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.